Welcome back to the channel. I'm Indy. I'm an enrolled agent and a QuickBooks certified pro advisor. In today's video, I'm going to walk you through how to file a business tax return. Whether you're brand new to business or an existing business owner, or you consider starting your own business and don't know how taxes work, this video is exactly for you. And the very first thing we need to talk about when it comes to small business taxes is your entity structure. This matters because your entity structure determines how your business files its tax return and whether or not your business is responsible for paying its own taxes. There are many different types of entity structure, but they all fall into two categories: pass-through entities or non-pass-through entities. A pass-through entity is one where the business income flows directly to the business owner's personal taxes. A taxable entity, on the other hand, pays the taxes on its income at the corporate level before any money is distributed to the owner or shareholders. Understanding the difference between these two are critical. For most new business owners, your entity will qualify as a pass-through simply because most new business owners fall into one of these two categories. You have a sole proprietorship, you have a partnership, you have single member LLC, and S corporation. All these are pass-through entities. This means your business won't be required to pay taxes on its income before distributions are made. Instead, the income flows to the business and gets reported on your personal tax return. Let me walk you through an example that makes it a lot easier to understand. Let's say you started a dry cleaning business this year and you structured it as an LLC, and you have a great first year and you make $250,000 in profit. Now, you're the only owner. Because an LLC is a pass-through entity, you will pay the income taxes on your personal tax return. Now, let's take a look at taxable entities. Certain businesses are required to pay income taxes at the corporate level and then get taxed again on their personal taxes, even when they take a distribution. The entity structure for this is called C corporation, and they are usually taxed twice. Most people starting a business don't begin with a C corp. However, as business grow, many may convert to a C corp for other strategic advantages, like preparing for an exit or securing a loan for the business where you're not the personal guarantor. If you're just getting started, you likely will not be dealing with this, but if you do have a C corp, know that your profits will be taxed at a corporate level, and then again, when you receive a distribution or a salary, it will be taxed again. If you have a pass-through entity, your business income is taxed at an ordinary income tax rate. The US uses a progressive tax system, meaning your business income is taxed in brackets. As your income increases and moves into a higher bracket, your income within each bracket is taxed at a progressively higher rate. The top tax bracket in the United States right now currently sits at 37%, and that applies to income above $640,000 and $600,000. The rate you actually pay depends on which bracket your business income falls into. For taxable entities like C Corp, the rules are different. Rather than the tier bracket system, C Corp pays a flat 21% corporate tax rate on their profits. Now let's cover self-employment taxes. That's something first-time business owners are not usually aware of until it's too late. The self-employment tax rate is 15.3%, which covers the Social Security and Medicare contribution as a business owner. If you own a pass-through entity, you will most likely owe self-employment taxes, and it's entirely separate from regular income taxes. On $100,000 of income, 15.3% is the tax rate, which is $15,300, and that's before you factor in federal or income taxes. This is one of the main reasons why converting to S corp starts to make sense for many business owners, especially for those profiting $50,000 to $60,000 per year. Now, let's actually look into how you actually file your business taxes, and the form that you'll use normally depends on your entity type. So if you're a sole owner of a business and it's not a corporation, you have to file a Schedule C form. This form tells the IRS about your business profit and loss, and it's filed on your personal tax return. And it's not a standalone business, so therefore your filing deadline is April 15th. So if you have a partnership or a multi-member LLC, you'll have to file Form 1065, and the IRS deadline for that form to be submitted is March 15th of every year. Now for S corporation, they report their income on a form called 1120S, also due by March 15th. Now for C corporation, they file Form 1120, which is typically due by April 15th if the corporation tax year ends in December 31st. So now you might be wondering, okay, I know what my entity type is, but how do I actually put a tax return together, or how do I get my taxes done? So to fill out a correct tax form, you need to gather all your business financial information, and that means pulling together all your accounting records, ideally a solid profit and loss statement from consistent bookkeeping throughout the year. If you haven't been keeping up with your books, this will make things a little messy. So now, if you need help with bookkeeping or accounting services, click the link below for a free consultation. My team and I can definitely help you. As a business owner, it's your responsibility to maintain accurate financial record, and you need to track every dollar of income and every business expense as well. Under code section 162A, you are allowed to deduct expenses that are ordinary and necessary and reasonable in pursuit of your business income. So if you brought in $100,000 but spent $50,000 on legitimate business expenses, your taxable income drops to $50,000. Tools like QuickBooks can help you keep your business finance organized, and don't overlook your receipt and bank statements. If the IRS IRS ever audits you, your receipts are what prove your business expense, not just your profit and loss statement. Once you have all your financial information together, the next step is filing an appropriate tax form into all your income, expenses, losses, and any other requested information. As a business owner, there's a whole wide range of expenses that you may be able to deduct, including home office, vehicle use, startup expense, your cell phone, legal fees, professional services, bookkeeping services, and more. Every legitimate deduction you claim can lower your overall tax bill. So you can file your taxes by completing paper form or using softwares like TurboTax or H&R Block to file your personal taxes. A lot of business owners also choose to work with a good tax professional, and honestly, that could be one of the best investments you make. Once everything is filled out correctly, the next step is to submit your taxes to the IRS before the deadline. So this covers everything you need to know when it comes to your business taxes. I strongly encourage you to consult a tax professional before you file your business taxes. If you need help with bookkeeping or business tax preparation, click the link below for a free consultation with me and my team. And don't forget to like and subscribe to the channel, and see you next time.